All right, so now we have actually added this calculation or property into your dashboard, and then this is how it looks. You have it here in the side panel, or here in your list. You can click into it, and then you can go through this little tour where everything is. You can skip it, but essentially this will be your calculation cockpit, or the cockpit to manage this whole property journey. Yeah, so obviously just initially to have a look and see what this property could do to your finances, but eventually, as we are a full end-to-end platform, we would help you to get financing, to view it, reserve it, buy it, everything. Anyways, so this will be it. So now you're in this sort of consider stage where you really, without any commitment, see how this property could look. Here you have some photos, you have floor plans. Again, this is an example. You have quick Google Maps where it actually is. You have things around property data. We also link here out to this price atlas so you can compare it to some market data from Immobilien Scout. You have all the calculation assumptions that we created this property with. You have some key numbers here. You have a notepad where you can chuck down your notes and revisit them. And then later on, if you would decide to move forward, we would also have your documents in here. But let's get started just to see or to show you guys what this actually can look like. So in here you have your verdict, which basically means hey, over 10 years, this property builds a certain amount of wealth from a certain amount that it takes in. But it also says hey, look, the rent does not fully cover the costs. Your tax position does, which is, again, one of the strong reasons why new builds are so effective, because they have higher tax benefits, and these new tax benefits can turn existing or properties that used to be a very high cash flow negative into something that's more positive, or even a bit actually positive. A few more stats, but again, the disclaimer, of course, these projections are based on the assumptions of the calculations, and we are not tax advisors or not financial advisors. So please, this is a educational page. Yeah. How we built it: you have a total wealth built, you have the chart, you have insights. These insights also have here, for example, in the total wealth built, there's 3 metrics that are important. You have your annualized return, which is something that you might also compare to, for example, ETFs. You have IRR, and you have your equity multiple. All fancy terms in terms of financing. You can do a bit more research on what these actually mean, or you can compare this to how ETFs perform, for example, because that's often a reference that people have learned in the last few years, where ETFs have become really popular. Here you can see where this wealth is actually coming from. So one thing here is you have your loan pay down, right? The repayment rate. You have your cash flow. So if this property is cash flow producing, it adds all the positive cash flow over the lifetime that comes on top. And then you have the appreciation. And the appreciation here is the bulk of it. Why? Because in this case, you have a property worth 530K. And even with a, let's see what I assumed here in terms of appreciation rate, 2%. Yeah, so even if it's just 2% per year on 500,000, that is a lot over time. Yeah, so that's why appreciation makes a bulk, and this is obviously leveraged with one of the big factors why real estate is so interesting, because you can't really lever ETFs like that. And you have a cost to entry. So this is really creating some clarity on what it would mean to buy this property. So in this case, here you have you're spending 42K on the upfront costs. So these are the purchase costs, basically notary, transfer, tax, and land registry. These are sunken costs, which means they are not going towards your equity of this. they're just gone. This is what you pay to enter this deal, basically. Sometimes this can also be financed with the bank, but this really depends on the market situation. So yeah, here it's called closing costs, upfront costs, whatever you want to call it. You have some more insights around that. And then in terms of survivability, this is where people spend the most time, obviously, because it's super important. This is about the cash flow. Yeah, we have here this cash flow chart. You have annual or monthly. And a beautiful thing about how we operate is that we also have the tax benefits separately. So you can also exclude them. So you could see if you would not get these tax benefits, how would this property perform, right? Or how, if you would get them later or whatever it is. Some people wish properties to be very positive without the tax benefits, and then that's just a nice thing to have on top. But a lot of these they work much better with, obviously. If you want to dive a bit deeper, you have that as a stacked version, so you can see exactly how this number is calculated: costs, interests, principal, so all the money that goes out, and then random tax savings is the money that comes in. And here the tax savings is calculated from us using your income, and then the German progressive zones. Here that we also verified that with an external tax advisor that went through all our calculations and see if it's proper. Obviously, the one caveat here is that tax brackets, etc., that can all change. We don't know what, we don't know how. So everything beyond this year or like next year is also partly speculation, but that's just how it works. There is always a bit of uncertainty on how these things can develop. In any case, I don't believe necessarily the taxes will come down, so they're more likely to be reduced more, or the ability to reduce them even further gets higher, if you know what I mean. Some more metrics, and then to the fun part, we have this scenario planner. So in here you have the same charts as you just saw above. You have a total wealth created with your returns, and then you can play with all the metrics that are relevant. So in here, for example, you have the holding period. So if I can just drag the slider here, say you don't want to sell after 10 years, but you want to sell after 17 years, you can see everything adjusted here. If you sell before 10 years, then there is a capital gains tax. So obviously that waiting that 1 year makes a big difference, as you can see. But I don't know, let's stay with 14 years. Obviously, one thing that also makes a big difference is the property appreciation. So let's say you not believe in 2%, but 1%, then just see how it is with 1%. If you believe, you know what, I did my own research, I think it's more like 3.3% or 3.5%, then you can obviously also do that. And then here, selling costs, you can also model in, see what the market gives and how much of that would impact the deal. Obviously, you can go back, you can reset everything. Then we come to cash flow. In here, you can see your rent. So for example, here, if you move the rent up, the cash flow gets better. If you move the rent down, the cash flow gets worse. I think that makes a lot of sense. We give you a range of like 30%. We put the rent based on the research that we do. So you cannot go to zero or you cannot go to infinity. Yeah, obviously with rent, micro location is key. Not everywhere in Berlin or Frankfurt the rent is the same. It really depends on the property. So here we give you a starting value based on our research, and then you could do your own or see what range you would feel comfortable. And if you deviate, obviously you could see the impact. You can also see the impact monthly. So for example, here, what 3 euros make at the end of the day, it's not even that big, gives you like 200 euros a month in difference. You can play around with the rent increase as well. So now, for example, you can also say, I don't want to increase every year, I want to increase every 3 years, but make it a 10% increase. Yeah, then you have these bumps. You can see them a bit better if you get out the tax benefits. which makes sense. Or you can also do custom rent, which you say, hey, the slider is disabled, but you can say, maybe in year 1, I only do 10K because I'm afraid it will not be rented for a couple months. Then you could have a look at that and see how that would impact your finances. In this case, I would read, hey, I need another 800 euros to cover losses, but then I should be fine. Now, or if you think you don't do anything, then how much would you need? You would need to cover 5K from your own pocket. But again, putting 5K from your own pocket for this eventually, right? You can see a tax impact here, how big the tax impact would be let me just reset this. The tax impact on your what this property does, and a bit more explained here. So this chart's very interesting. So basically your taxable income with our property is 100,000. But because now you have all the things deduct your taxable income, you have a new taxable income that says with property, and that at a certain percentage of your income is creating this gap. And obviously here with this darker line, you would want to go as close to this green line as possible, because that green line would mean that and we have inflation and counted in here, that would mean you pay 0 income tax. Then you can also play with the financing. So let's go maybe here to the cash flow charts and maybe put it up to 4.7. Yeah, could you manage that? Or maybe 4.1, you can see the difference here. Maybe monthly, the difference here would make 400 versus 300. Yeah, so again, it's not such big of a deal because of how all the things work together. And then you have the last, which is the income. You can change your income and you can try custom scenarios. So for example, in here, you have your leave Germany after a certain amount of years. You can have a quick visualization. What it does, it basically sets your income to 0. So what happens here is your income goes to 0, you lose the tax benefits, and therefore you would also lose the cash flow supplementing tax benefits in this case, right? So you can see here these numbers would then 242 would stay the same, 242. So these here you still have tax benefits to help. Here you don't have tax benefits to help anymore. So that's what it does. You can also try other scenarios. I mean, it's not always negative, can also be positive, right? What if you get a raise in year 3, for example? Then you would see it here as well, and you would have more room maybe to buy a second property, right? This is how you think about it. There are some more supporting tables here. So if you want to dive deeper and you want to know how this actually is calculated, so you have your rental income, for example, then you have the depreciation of the property, you have interest, other costs, which creates this difference here, and then this difference here is put in here. So it creates a taxable after, tax before, tax after, and then your tax savings. Yeah? So this is how this is calculated. And yeah, this is our scenario planner calculation. You can get that for all the properties you want to look at for free, and more videos coming.